One question we picked up from ACCA website. This is actually, if I'm not mistaken, it is September, December sample exam paper. And we picked up this consolidation question. Not really very difficult, but let's start doing it. So I'll have a quick reading with you, and then we will discuss these adjustments. And by the way, this is for Consolidated Statement of Financial Position, SOFP. So the question starts with, it says, Limited Company has prepared a draft statement of profit and loss for the year ended 30th September 2008. Now remember that whenever you are doing consolidation question or any other questions from your F7 or whatever, you need to pay attention to the dates. So financial statements are ending on 30th September 2008. Before any adjustments required by notes 1 to 4, so we'll read notes 1 to 4. The draft profit has been added to the retained earnings. So they have given us the retained earnings, and this includes the profit for the year. Has been added to the retained earnings and the summarized trial balance of Limited Company as at 30th September. So 30th September 2008 is our reporting date. This is end of the financial year, and so equity shares 10,000, retained earnings as at 30th September 2008, and it is draft, which means that it is not final. We may need to make some adjustments, and it includes the profit for this current year. Office building at cost 20,000, factories at cost on 1st October 2007. Note 2. So remember that this is year ending 30th September 2008. Office building accumulated depreciation on 1st October 2007. So this is actually, when you subtract from this to this, you get net book value. Okay, but this is actually at the beginning of the year. This is beginning of the year. This is beginning of the year. So it looks like that for this year's depreciation they have not added. They tell us that they have added the profit in here, but that profit is not correct because they have not calculated current year depreciation. If they have added current year depreciation, they should have told us that this accumulated depreciation is on 30th September 2008. It is not on 30th September 2008. It is at the beginning of the year. So it means that whatever profit amount is inside there, that profit is depreciation has not been subtracted. So we need to calculate current year depreciation. Okay, so they told us accumulated depreciation, this one, beginning of the year, accumulated depreciation, beginning of the year. So two depreciation will calculate. Environmental provision at the beginning of the year, which is 1228. Okay, so there is some provision, but that is also called opening provision. This year, unwinding, if you remember, we do provision unwinding, IS 37. So when you have a provision, you unwind it every year, increase it every year, charge it to income statement as finance cost. That has not been done. Current liabilities are 34,500. Current assets are 14,700. Proceeds of 5% loan note is 5,000. This is for note 1. This is note 3. This is note 2. Interest paid note 1 250, and suspense account note 2 3,500. Remember that suspense account, it appears in, sometimes it appears in the trial balance, but in your final financial statements, in your statement of financial position balance sheet, the suspense account does not appear. So we have to remove the suspense account and we transfer this amount to somewhere. What is suspense account? We have done it in F7 as well. There are certain transactions about which we are not very much clear the fate, and we are not clear where to treat them, how to treat them. It's not finalized or something. So we put it for temporarily, we put it in the suspense account. So that's a temporary account. It's a temporary account. It does not go to the final accounts. So we will remove this suspense account. Now, what we need to do, we need to read the notes carefully and then do our working. So first working is loan note, which we issue for this 5 million at 5%. So the first note is about this one. It says that a 5% loan note was issued on 1st October 2007. It is very important to pay attention to the date, because for the loan note, you need to calculate the interest cost, and interest cost is always for the period. So we need to see how much period is there. I know that we are preparing financials on 30th September 2008, and the loan note was issued on 1st October 2007, which means that it is a full 1 year, and that makes our life easy. Because sometimes they issue the loan note probably on 1st of April 2008. Then you would have to consider 6 months interest. So it is a full 1 year. So when things start coming in for full year, they become easy because you don't have to find out the monthly charge or proportionate charge or something like this. So anyways, it is a 5% loan note given on the first day of the year. 5 million was the face value. Direct cost of the issue amounted to 0.125 million, which means 125,000. These are the issue costs, direct issue costs, and they were charged to profit or loss. This is a mistake. We never charge them to income statement. Remember that if you take a loan from the bank for 100,000 and you pay 5,000 as the charge, bank charges or whatever, loan charges, loan issue cost, so 95,000 you receive. This night you should be treating your loan opening liability. Your opening liability is always 95,000. Okay, although from the bank you receive 100K, but in your books you will write down your opening liability 95. So this 5,000 is not charged to the income statement. It should be subtracted from the balance sheet from the liability amount. This is what you need to understand. They take it to profit or loss, which means that they showed 125,000 expense in P&L. They deducted it. Now we are going to add it back. We have to add back to the profit. The loan will be redeemed in 5 years' time at a substantial premium. Substantial premium, which means that we might have to pay more than 5 million, but how much we don't know, which gives an effective interest rate of 8%. So your interest rate is 8%. So you are actually giving them 5%, but you are going to redeem it at a premium. So for you, the true interest cost, your finance cost will be calculated at 8%. Finance cost will be calculated at 8% on opening liability. On opening liability. Annual repayments of 250,000 are paid on 30th September each year. So this is actually, so 250,000 is the interest. This is exactly what we were discussing in our last session when we were doing IFRS 9, and we had an extra session last week as well, and we discussed that what is amortized cost. So I'll explain it again here. So what happens that we have here 5 million, our opening liability here. Opening liability here is 5 million, and we have to say add accrued interest, and that accrued interest will be charged at 8%. 8%. So I'll take this thing into 8%. And actually, I'm sorry, not opening liability will be this much. I would say that direct issue cost. So direct issue costs are 125. So this is, I'm 5 million, I'm putting at 5,000. So I'm putting 3 zeros on the top. So this is actually 125,000. I should take it as, so be careful with the numbers, okay? Either you can put all 6 zeros, like 5 million can be written like this. Instead of putting so many zeros, you just put 3 zeros, and 3 zeros are on the top so that you don't have a lot of zeros in your calculation. And then 125,000 means 3 zeros there as well. So your opening liability is actually now, this is your opening loan liability. Call it loan liability, bond liability, whatever. So this is my opening loan liability, which is 14875. And then on this 4875, I take 8%. And let me just, and this is going to be added to my interest, okay? Because this is going to be added to my, so my initial liability is 4875 plus my interest 390 and less interest paid. Which, how much you pay? You pay at 5%. And 5% of what? Of 5 million. So 5 million into 5%. And into -1. I'm putting -1. So this is 250, which I have paid. So this is my closing loan liability. Now, in your balance sheet, you call it closing loan liability on 30th of September 2008. And remember that this number should go to your P&L as your finance cost, and this number goes to your statement of financial position as your loan liability. Now, these guys were, when they were preparing this thing, they were showing it at 5 million. Loan liability is not 5 million. At the end of the year, loan liability should be 5015. Okay, 5015. A very typical calculation, and most of the times it is done in the same way. I can call it, working one, which is my loan liability and finance cost. And by the way, I'm sorry for, I just actually started doing this calculation because I thought that you guys might have read all of these notes because I gave you some time. If you want me, I can continue reading the question first because I feel that some of you people might have joined late. So first working was for loan notes, and I just showed you the working of the loan note. The second working was about non-current assets. So let's discuss non-current assets as well.
Say it.
Yes, please.
Let's say just a quick question.
Yeah. This one is here actually. This is your statement of financial position. Loan liability is 5015.
Okay.
250 you have paid.
Paid interest. Okay. Yeah. So that one will go to the income statement.
Income statement. This one will go 390.
Okay.
That I wrote P&L. In your P&L, you never write on 5%. If you remember last lecture, I said that 5% is only used for calculation that how much cash I have to pay. That's all. This is what I'm paying out cash. But my actual expense is at 8%.
Which is the WACC, no?
Which is what?
WACC.
Maybe effective interest rate, whatever you may call it.
Oh, nice.
Okay, the second adjustment is about non-current assets. It says that Lugan Company acquired an office building for 20 million on 1st October 2002 with an estimated useful life of 25 years. Okay, let me just see. I'll read it later. Non-current asset is second adjustment. Third adjustment is about environmental provisioning. Fourth adjustment is about deferred tax. Okay, 4 adjustments they have given us. And the requirement is, there are 2 parts of the requirement. First part of the requirement, it says, prepare a schedule of adjustments required to the retained earnings. So as we discussed before, that retained earnings, they have calculated 4,042 or something. I don't remember. But whatever these retained earnings, they are not correct because there are some adjustments which we need to do. So they ask us to find out the adjustments made to the retained earning of Lugan Company at 30th September as a result of the information to note 1 and 4. So whatever retained earnings were given in the trial balance, we need to correct them based on the changes which will occur because of these loan notes. And then part B, it says prepare the statement of financial position, balance sheet as at 30th September 2008. So 2 questions are here. 8 marks for retained earning correction. They give us, I think, 4042. We need to correct it. This is for 8 marks. And then we will prepare the balance sheet. And now the question is that in order to correct these retained earnings, this part, you need to do calculations. You need to provide these workings for these loan notes. Because how much retained earnings are given? Let me tell you. Retained earnings were given as 4122. Okay, 4122. And this number is not correct because this number also does not have depreciation. We did not calculate depreciation. So we will calculate depreciation. We will also see that this interest we have to charge it. This number they subtracted it before because they told us that this 125, which is 0.125 million, it has been subtracted. It has been charged to P&L. So that 4142, you subtracted this 125,000. You should add it back. Okay, we will add back 125. And then we will subtract this 390, our interest cost. So these are the adjustments which are related to the loan note to your retained earning. So let's see what other changes we need to do. Now I start reading this adjustment number 2. Lugan Company acquired an office building for 20 million on 1st October 2002, which means some 5-6 years ago, with an estimated useful life of 25 years. Okay, 20 million divided by 25 million. Okay, depreciation is charged on a pro rata basis. Pro rata basis means that if you acquire or sell the asset during the year, you calculate depreciation for monthly basis as well. If there are 2-3 months, you need to calculate on monthly basis. And then it says that on 1st April 2002, now this is happening in the middle of the year because the year starts here on 1st of October 2007 to 30th of September 2008. This is my financial year. It says on 1st October 2008, which means that 1st April 2008, exactly in the middle, 6 months, 1st April 2008. What happened? The building was deemed to be impaired as its fair value was estimated to be at 12 million. So at this point, it is 12 million. Before, when we purchased, it was 20 million. At that date, the estimated remaining life was revised to 12 years. So from this period onward, we said that it will revise the life and it will have further 12 years. So 12 million will be the book value and 12 years will be the life. Ignore the deferred tax consequences of this revaluation. Lugan Company, now that is another thing. Lugan Company had 10 factories. So what we need to do, we need to calculate what is the impairment here. So we know that at the beginning of the year, what is the value? We will calculate this depreciation of 6 months. After calculating the depreciation of 6 months, we will find out the net book value on this date. And this net book value compared to 12 million, and that would result into impairment. Okay. So we'll see that it was 20 million in the beginning. Then how much it was in 2007. So beginning of 2007, it is not 20 million actually. Beginning of 20 million was on 2002. So we'll see that how much it is here. Beginning of 2007, what is the net book value minus the depreciation, 6 months, whatever number comes up, we compare with 12 million and we find out impairment. And then from this period, we charge depreciation, 12 million depreciation divided by 12 years, which means, life is 12 years multiplied by 1 by 2. 1 by 2 because I want 6 months here. So this is going to be my depreciation for this period. So I have depreciation here. I will have depreciation here. So this one calculation is going to tell me the depreciation for the year because we said that current year depreciation we did not calculate. So first 6 months depreciation, then impairment, then the remaining 6 months depreciation. That is going to be interesting calculation. We'll do it together now. Then it also had something more. So this is about office building. And now this is about factories. Lugan Company had 10 factories, okay? 10 factories. On 1st October 2007, Lugan Company sold one of its factories with a carrying amount of 3 million, balance sheet value of 3 million, 5 million cost, 2 million depreciation for 3.5 million. So a $3 million balance sheet value, net book value asset, you are selling for 3.5. So $500,000 is your gain on disposal. The proceeds were credited to the suspense account. Yeah, remember there was a suspense account which was showing 3500 in the trial balance. So this is where it is coming from. You see this one, this 3.55 which they put on the suspense account. This is actually the money which they received by selling this factory. No depreciation has been charged on any non-current asset. For the year ended 30th September, the factories are depreciated at 15% per annum using the reducing balance method. Factories are reducing balance method 15%. Office building was straight line method of 25 years. Okay, 15% factories we have to depreciate. Then there is an environmental provision. Now, before I do environmental provision, it is better that we prepare our working for non-current assets. Otherwise, we will just put a lot of information on ourselves. So let's make things easy. Working 2, I would call it PPE. Okay, let's give it a name PPE. And within PPE, you have buildings which we need to calculate, and you have factories which we need to calculate. Okay. So what is the buildings case, and what is the case with the what is building? 20 million was here. This is on 1st October 2007. Office building at cost 20 million, at cost 20 million. Until 1st October 2007, depreciation is 4,000. So it means that on 1st October 2007, so I would say that 1st October 2007, building cost would be 20 million minus 4 million accumulated depreciation until here. So you see that 20 million was when you purchased in 2002. From the remaining years, the depreciation is 4,000, but this is until the 1st October 2007, which is beginning of the year. So I take it here, how much it makes me. So beginning of the year, my building had 16 million book value. And then we need to charge depreciation for 6 months until 31st March, okay? Because on 1st of April, what happened? If you remember that in case of buildings, they told us that on 1st of April, there was an impairment. So I need to find out that what is the book value on 1st of April. So 6 months depreciation I need to calculate. And the 6 months depreciation, because it is 25 years life, right? It says 25 years life. So I would say 20 million divided by 25 years, 1 year, multiplied by 1 divided by 2. So 6 months depreciation I'm trying to calculate. So in 6 months, how much depreciation? It becomes 400. And let me put it with -1. So it means that my net book value, I would say that net book value on 01, 04, and 2008. Now, this is the number I needed. Because now they tell us at this point that fair value, now it says that the fair value was established to be 12 million. Now, on this date, the fair value is 12 million. And then I would say that, let me copy paste it here. And I would say not net book value, I would say fair value. So fair value on the same date was 12 million. So it means that there is an impairment. So this is impairment on building. The impairment value would be 3.6 million. Now, this 3.6 million will be charged to my income statement. We did not charge to the income statement. So what goes to income statement with reference to this building? First income statement, I will charge this as depreciation. This will go to depreciation to P&L. This will be like impairment to P&L. And then what happens? I write down this thing again. And remember that we have to calculate full year depreciation. Okay. So then I say that depreciation charge for remaining 6 months. 6 months until 30th September. The last 6 months of the year. Let me just say remaining 6 months. Let's call it like this. Okay. So now it will be 12 million because now the value is 12 million and remaining life is 12 years. They tell us in question that it is 12 million and the remaining life has been revised to 12 years. So I need to calculate new depreciation. So I'll say 12 million divided by 12 multiplied by 1 divided by 2. So this is 1 by 2 means 6 months. Okay. So how much is the depreciation expense for the next 6 months? It is 500. Now this number will also go to P&L, depreciation to P&L. Okay. So I'm just putting notes here. So when I put it like this, and then I would say that net book value at 30th September 2008. So in my books, this asset will be shown as 11,500. So this goes to my SOFP. Okay, this number is in statement of financial position for my net book value of buildings. If you have any question, please ask. Nothing. Okay. Then we talk about factories. So if we talk about factories, how much is the cost? It says factories at cost 40 million. Factories accumulated depreciation is 11,500, 11,100. So we get the net book value, whatever. And then it says that one of the factories was sold. Now, if I remember the note, it says that there was one factory which had a book value of 3 million. They sold it for 3.5 million, and they made a 500,000, which is $500,000 gain on disposal. So I would say factories, and like this, I'll put it here. I'll call it factories. Let me drag it down because it is going to create a problem. Factories at cost. So what is the value? 40 million, 11,100. So 40 million factories minus 11,100. So there were 10 of them, 10 factories if they have, and they are selling one of them. So 28,900 is the book value. Now out of this thing, what you did, you disposal of one factory, and that disposal is for 3 million. So what is remaining book value is 25,900. So this is net book value of factories. Now you pay attention that they are selling this factory on 1st October 2007, beginning of the year, the first day of the year. And that is why I subtracted it on the beginning of the year. It is on, 1st of October 2007. And then I charge depreciation. Now, if you please pay attention, this is important. First I'm selling it, then I'm charging depreciation on the remaining because they told us that depreciation is charged on 15% reducing balance. So reducing balance is on the net book value. So I calculate the net book value and then I charge 15%. So how much is that? If I take 15% there, it should be 25,900 times 15% times minus 1. So it is 3,885. This is my depreciation and it goes to P&L. Listen, if they tell you that this factory was sold at the end of the year, like on 30th September 2008, if they tell me that it was sold at the end of the year, then I would have calculated depreciation on this amount, 28,900. But they told us that factory was sold in the beginning of the year. So therefore, I calculated depreciation on the remaining amount. If they tell us that factory was sold in the middle of the year, then what you would have done? Maha, what you would have done if they told you that factory was sold in the middle of the year?
So then we would have calculated the depreciation for the first 6 years, and then that thing would have been added.
Exactly. So we have here, we have this thing. I'm sorry, just put it properly, like this. My opening value here is 28,900. And I assume that I sold the factory on this date, and therefore I'm subtracting 3,000, and whatever is remaining, I calculate depreciation. And then I calculate depreciation. If in the question they tell me that you sold the factory on 1st April, let's suppose in the middle, 1st April. So then what would I have done? That 28,900 in the beginning, and I leave it like this, and I multiply with 15%, and I multiply it with 1 by 2. So 6 months depreciation I would calculate on this amount. And then I would sell this one factory on this date, and the remaining amount becomes 25,900. And then I multiply it with 15%, and I multiply it with 1 by 2. So 6 months depreciation, 2. I would have done it separately. So thanks to the question, they made life easy. They said that it was sold in the beginning. So everything is solved. So you need to be careful, be attentive about the dates. So now 3,885 will go to P&L, and when I take the difference, it makes me 22,015, and that is my net book value at 30th September, 2008. This is the number which I'm going to take it in my SOFP. This goes to my SOFP, okay? And I would say that total PPE, total property plant, because in balance sheet, we don't show it separately. We don't write down in balance sheet, land and building and factories. You write down PPE. So total PPE is like building plus factories. And that would be a total of these two numbers, okay? 11,500 plus 22,015. This goes to your total to SOFP. Okay. Any question you want to ask until here?
Just the impairment for the building.
Please ask.
The impairment, can I see the
impairment happened only on here, this 3,600. This is impairment. There is no impairment on factories. On factory, what happened? I can say that gain on disposal of factory. This is gain on disposal of factory. This is what I would do. Gain on disposal of factory would be, I can call it working 3, okay, like this. Working 3, gain on disposal of factory, I would say that disposal proceeds, which are 3.5 million, net book value of sold asset, which is 3 million, and this is 500,000, and that goes as gain, and it will go to your P&L. So this is my gain on disposal. This is one calculation I need to check. So I'm just finding out, because the question asked me that please correct the retained earnings. Retained earnings include current year's profit. So I'm just making adjustments to see that what are the entries I'm going to make adjustments into my retained earnings. So I'll see that this will affect the retained earning. This number. This number will affect the retained earning. This will be added back. This will be subtracted. This will go to my retained earnings, 400. This impairment will go to the retained earnings. This depreciation of the building, again, it will go to the retained earning, subtracted. This depreciation will be subtracted from the retained earning. This 500 will be added to the retained earning, because they told me retained earning value for 122. But then they told me that these are the adjustments. And because of these adjustments, there will be impact on the retained earnings. So the numbers I put in red, these are going to be added, subtracted to the retained earnings. Am I clear on that?
And so the impairment will also be subtracted, right?
Sorry, what?
Impairment will also be subtracted.
Yeah, impairment will be subtracted. Impairment will be subtracted. Okay, then there is another working for this environmental provision, and let me call it working for. Let's read it quickly. It's a short note. It says that Luton Company has an obligation to clean up environmental damage caused at one of its factories sites during 2007. So we already have the provision. The cleanup is due to take place. So there is nothing changed. It is still a liability because we still have to do it at the end of the factory's useful life, end of the useful life. The liability has been accounted for appropriately. The liability, which liability? It was given in the trial balance. If I scroll up, you see that this is the liability. This liability, 1.228 million. Okay. So they say that this liability has been accounted, which means that this 1228 number is correct. When it says that liability has been accounted for appropriately, which means correctly, at 1st October, but it is only at the beginning of the year and represents the correct present value at that date. The number value is correct, but the only problem is it is on 2007, 1st October. It is at the beginning of the year. Luton Company has a cost of capital of 5%. Now we know from IS 37 that we need to unwind the provision. So I would say that opening provision, and let me call it working for, which is my environmental provision. Opening provision is 1,228, if I'm not mistaken. Let me check it. Yeah, 1,228. And we have a cost of capital of 5%. 5%. And 5% will be, we call it unwinding of provision. And unwinding will be done at 5%. So, and it is for full 1 year again, multiplied by this amount, which is 61.4. And this now becomes closing provision. So in my statement of financial position, this number, 1,289, my friends, this is the number. 1,289 will go to statement of financial position as my closing provision, okay? And this 61.4, it will go to my P&L as my finance cost. You call it interest expense or finance cost, whatever. This 61.4, again, this will go to income statement. This is going to impact my retained earnings. Clear? Nothing else. It was rather simple. Then it says the last note, which is working 5, which is for deferred tax. Now let's read this thing together. Deferred tax generally has, okay, at 30th September 2008, the tax written down value of PPE was 25 million. the income tax rate applicable to wooden companies 20%. So they told us that the book value of our assets is 25 billion. Now you know that deferred tax asset or deferred tax liability, it arises when you have a difference in the tax base and the book value, difference in the tax base and the carrying value. Now tax base means the value of assets in the textbooks, what the tax department considers. For example, they told us that you have got tax base of PPE. Only PPE we are talking about. Tax base of PPE is 25 million, and then we know that carrying value of PPE. So carrying value of PPE we calculated above. PPE was this one, property, plant, and building and factories. So there is a difference in the tax base, and that difference will give rise to your deferred tax asset or liability. And because you have difference in tax base and book value and carrying value, how much is the difference? The difference is 8515, and that 8515 it will give rise to deferred tax liability. Always remember that if your carrying value is more, you have a deferred tax liability. If your carrying value is more, you have a deferred tax liability. So we will have a deferred tax liability. So 8515 is not the liability. I say that give rise to deferred tax liability, and my tax rate is 20%. So it means that deferred tax liability will be 8515 multiplied by 20%. 8515 times 20%. This is what my liability will be, or should be, not 1703. The liability, your deferred tax liability, it should be, this is my closing deferred tax liability. And let me say that it goes to SOFP. So in statement of financial position, I will show my liability as 1703. But then you always see how much is already shown in the books beginning of the year. The beginning of the year, you have a deferred tax of 1500. So your total deferred tax liability is 1703. 1500 you already have recorded. So I would say that opening liability was 1500. And movement, the word is movement in deferred tax liability. The change, the difference is 203. And that 203 is increase in the liability. And therefore, this goes to my P&L as tax expense. This is your tax expense, 203. This is the last item we calculated that it should go to P&L. So these are the things which are going to impact my retained earnings. Now, what we need to do, we will take our opening balance of retained earning, which is 4122, and then we will start adding or subtracting. Now, you guys might be thinking that this is just an 8 marks question, and we have spent quite a lot of time on that. Yes, we spent quite a lot of time for two reasons. Number one, that I'm explaining you, I'm not doing myself, and I'm doing it slowly. When you do it in exam, you will do it faster. And number two is that these are the same workings which we are going to use in the balance sheet. Now, making the balance sheet will be like a 2-minute job because all of the calculations we have already done. So this working which we have done, 1, 2, 3, 4, 5, it is not only for part A. In fact, these will also solve by part B because part B says make balance sheet, and I've got all the values to put in the balance sheet. So which I put P&L, they are going to be adjusted in part A. When I wrote down SOFP, these things are going to be put in the part B when I'm making the balance sheet. Am I clear?
Can you?
So as we discussed, we calculated all the numbers. Now we just need to put in the schedule. Our requirement number A, it says that adjusted retained earnings. Okay, adjusted retained earnings, because they told us this is what they request. They required us that prepare a schedule which in a table format of adjustments required to the retained earnings as a result of the notes 1 to 4. So what is we say adjusted retained earnings? I would say that retained earnings as per PB, as per trial balance. So in trial balance, it was given 4122. This is 4122, and I know that this is not correct. What are the mistakes? Number one, I remember add back the loan issue costs. Okay, we said that before they subtracted the loan issue costs, which they should not have. So we add back. Then I say less finance costs, and the finance cost for this loan we should subtract it. Then we should do less depreciation on building. Then I would say less, because they did not subtract the depreciations, less depreciation on factory. They told us that depreciation had not been charged. Then I would say impairment on building. Then there was, and this was impairment, it was also less. Okay, these are losses. Then I would say add gain on disposal of factory. So I'm just writing it down what comes to my mind, and then I will see if there is something missing, I will add it. Then I would say less finance cost on provision. So unwinding of provision, finance cost, interest cost, we should do it. And then I would say less deferred tax charge. So these were the things. Now these numbers, I remember that loan issue cost was 125,000. This was minus, I will add it back 125. It is going to increase my retained earnings. Finance cost is going to decrease my retained earning. Finance cost was 390, this 390, okay, which you see it here. This 390, I'm taking this 125 I took. And finance cost is subtracted, so I put minus 390. Then it says depreciation on building. On building, there were two depreciations. I think building, yeah, this was building. This 400 and 500. So 900 depreciation we have to subtract. So minus 900. I'm not linking it. Actually, what you should be doing, you should be linking it like this, is equal to 125 into minus 1. So that when you make a change up there, you get a change here. So 390 into minus 1. I'm subtracting it. And this is 900 like this. Okay. Then depreciation on factory. How much is the depreciation on factory? I think 3,800 or something. This one. This I do. Then there is an impairment. Impairment will also be subtracted. Impairment was 3,600, and I multiplied with minus 1 so that it is subtracted. Gain on disposal 500. I remember 3 million assets sold for 3.5 million. So I added back finance cost on this one 61.4. This I subtract. Deferred tax is a liability. That is a charge 203 into minus 1. I don't think there is anything else left over. That's all. Yeah, I don't remember anything else. And we make a more. Now remember that when you are at 412, okay, this is 3885. These numbers are in decimals and millions. Wait a minute. Okay, 28 factories at cost, 289 million. What is the factory at cost? I put these, so you see the numbers are huge. It's 38.85. Let me just correct this number because there's a error in those zeros. Factories were cost at this much, 3 million, 25,900, and no, the zeros are correct. Zeros are correct. So retained earnings are actually moving into negative. You see here, retained earnings, adjusted retained earning. Now that's very interesting, my friends. After making all these adjustments, you have got a negative retained earning, which was a positive 4 million. From positive 4 million, you have moved to a negative 4 million, negative 4.2 million. So this 4.292 million will go into the balance sheet as a negative number. It will go to the balance sheet as a negative number, 4292. Okay, this is done with part A. Okay, if you have any question, please ask me. This is answer to part A. Part B requires us to make statement of financial position for, I don't know, what was the name of the company for Alpha company? I just write down like this, as at 30th 09 2008. So this is my.
Sorry for the interruption.
Yeah, please ask.
Sir, you are repeating the question, or is there any other part you are solving, sir?
No, I'm just doing the question. I'm not repeating it.
Okay, sir. Thank you.
We started it more than 1 hour ago. You joined us now.
Yes, sir. Sorry, I was
So
late.
that's why I mean, I'm just continuing with the question.
Yes, sir.
So you've got here assets, and of course, within assets, you have to write down your non-current assets, and within non-current assets, you have PPE. What are in the trial balance? Now, I need to drag down this trial balance. Okay, this trial balance, I will take it down, and I will put it somewhere here so that we don't have to scroll up and down again. So I've got here my PPE, and PPE value we calculated above. How much was PPE? I think this is 333,515. So this is my PPE, which includes everything. And then what do you have here? No other non-current assets. There are no intangible assets. There are no investments. So there is only one non-current asset. And then you have your current assets. And you can actually write down here non-current assets, okay? So that you follow one format. Within non-current assets, they don't tell you inventories and receivables and prepayments separately. They just give you one number, which is 14,700. So you just write down one number, 14,700. And there is nothing else. And this is your total asset. So it's pretty much easy. Your asset side was simple. Only two categories of assets, and there is nothing else. And this makes 48,215. And I put it like this. And let me just make it like this so that it becomes clear. The second side is your equity and liabilities. So you see that the time we spent only was on how to say workings. Putting it into the balance sheet is rather easy. Equity, you've got share capital, and you've got retained earnings. Okay, so you don't have any reserves or something else. There are no share premium accounts, no reserves accounts. The balance sheet only show you two things: equity and retained earning. Equity is 10,000, and your retained earnings are now, which you have adjusted now, which is minus 4892. So this is your equity portion. If I make a total, so this becomes my equity. Okay, so this number I need equity 5.7 million. Then you have your non-current liabilities, and you have your current liabilities. Non-current liabilities are my, I think, only loan notes. And I can put here deferred tax. Okay, these are the two items I put in my non-current liabilities. So loan notes we calculated above. In the balance sheet, they are showing us 5 million, but this is wrong. We are not going to use this 5 million. We will use the amount which we calculated for loan notes, which was 5,015,000 or something, the first working. And you actually, if you want, you can write down here working 5. You can call it working 1, something like this. Okay, non-current assets. Maybe this is working 3. I'm not sure working 2 or working 3, but you can write down like this so that it becomes clear where you are taking the numbers. Deferred tax was, now let me write down correct number. Deferred tax working,
Sorry, sir.
Working 5. Yes.
Hello.
Yes, I'm listening.
57,000. Is that correct? This equity, total equity.
Yes. Is there something wrong?
I'm failing to find it.
So deferred tax is, how much is deferred tax? Deferred tax is 1703 we calculated. And then I have my current liabilities. Current liabilities, please turn off your mics, please. Current liabilities again are given in the question 34,500. So nothing to be done about it. 34,500. And then I say total equity and liabilities. I will take questions once I've done with that, because I know that if I start answering things, we might miss some numbers. So it makes 48,925. Where is the difference? And there is, see, the difference has come in, and the difference is 1289. Yeah, 1289 was the provision. So you have here environmental provision. You see, when we shift the focus while making the balance sheet, this can happen. So environmental provisioning we calculated, and we did not write down. We take the charge of 61 to the P&L. This 61 we take to the P&L. This 1289 we should take it to the balance sheet. And now when I make a total of, so I take this 1289 as well. Now it is equal. So this is your balance sheet. Now you asked me about the equity. Equity is actually the sum total of share capital, share premium, retained earnings, and reserves. So my share capital is 10,000. Retained earnings have become negative 4.2 million, which means that there has been accumulated loss. So my equity actually has decreased. Equity is 5.7 million. That's it.
All right, sir.
And difference is 0. So balance sheet is both sides are equal. So this question actually took more time on how to say making the calculations. There is one thing which I must tell you, which I saw a little bit strange in this question, and I do not agree. I feel that there is a mistake in the question and there is a mistake in the solution. There is one mistake which I do not feel like that it should be like this, and that is actually probably they put it deliberately. Maybe they put it deliberately. When I made this calculation of, so my question is done. Okay, my question is finished with you. I'm just now telling you that there could be an exam, a different situation, and you should be ready for that different situation. I come back to the first loan note. See here. We said that loan note had, now all of you guys please listen carefully. Opening liability, we said that 5 million issue bonds or loan notes. We had some direct issue costs of 125,000. We subtracted 4875. And then we said accrued interest 8%, 390, and then interest paid 250. Now, where did I take this interest paid? In the question, when you see that here, when I take this number here, They said that interest paid 250 and they put it on the debit side, on the trial balance. We did not discuss this nothing again a lot. Usually what happens, I assume, normally what happens, I understand that their actual interest charge should be 390 according to IFRS 9. Interest charge should be 390 because they paid 250, like they are paying 250, like 5 million into 5%, 250. They are paying 250, and in many cases they take to P&L 250. See what is happening. What generally they tell you, now this is a different question, but in most questions they will tell you that the company charged 250. They paid 250 and they charged 250 to P&L. And whereas actual interest should be 390. So this is what happens, that 390 should be there, but they charge 250. So what you do, that you have your retained earnings and you say, okay, I need to charge 390, I subtract it, but the previous 1,250 you add back, because you say that they mistakenly, what did they do? They mistakenly charged 250, which is less. They deducted it. So I add back 250 so that it comes to the actual position, and then I subtract 390, which is the actual. In this case, we did not treat this 250. If you see our retained earning calculation, now what I'm doing, showing you here now, please pay attention. When I made this retained earning calculation here, I said that their retained earning is 4122, this is their profit or retained earning, whatever, and then I subtracted 390. Because I assume that they did not record anything in the P&L. I assume that they are telling 4122 profit or retained earning, and they have ignored the interest cost. Therefore, I subtract 390. But sometime in question they tell you that they mistakenly charged 250. So if they tell you that they already have charged 250 by mistake, whereas the correct is 390, then what you should do, just like you say add back this thing, you will say add back wrong interest or whatever, incorrect interest, you add back 250. After adding back 250, then you say subtract the correct amount, the correct interest. You do two things here. But in this question, I did not do 250 because in the question language, because they did not tell you. If you read the note, if you read note number 1, where it is, this is note 1. The note 1, it says that the company charged the direct cost of the issue 0.125 million were charged to the profit or loss. They did not tell you that interest was also charged. In some questions, they will tell you that interest was also charged. Interest 5% was charged to P&L. So if they tell you that interest 5% was charged to P&L, it means that they previously subtracted 250, which was wrong. So I added back and then I subtract 390. Am I clear on this thing?
Yes, sir.
This is the only thing which I saw slightly different than usual, because most of the times in questions they will tell you that company had paid 5% and they have charged 5% to P&L. So you have two options. Like you could have said two things. One, you should say 4122, and because they subtracted 250, so you have two options. One, you can say that add back 250, add 250 and subtract 390. This is one option. Or what you can say that 4122 and 390 and 250. How much is the difference? 140. So you subtract 140. You say that they subtracted 250, they should have subtracted 390. So let's charge the difference. End result is same. Either you charge the difference again, subtract the difference, or you make like this. I prefer doing like this. So this is end of this question. This question was taken from your ACCA exam, ACCA website. It's September-December 2020 sample exam question. We did it together. It took us like 1 hour and 15 minutes. When you will do it in exam, you should be doing it much faster. If you have any questions, please ask me.